Hello everyone, today we are studying for Accounting 370, which is external financial reporting. We have our final today. So the topics we'll be covering, first off, is investments. So the two types are debt securities and then equity securities. So first off, with debt securities, the way you account for them depends on the type of debt security that it is. If it is a hold on 1 second, let me get my pointer. If it is a held to maturity security, which means you intend to hold it for basically until it matures, you recognize it at its amortized cost and you ignore the fair value adjustment. For trading securities, where you intend to sell them within a year, you recognize them at fair value and you put the fair value adjustment within net income. And then lastly, available for sale securities are not a trading security and are not held to maturity. They are recognized at fair value and you put the fair value adjustment in other comprehensive income. Net income is obviously on the income statement, and then other comprehensive income is within the balance sheet, which I'll talk a little bit more about later. And then we have two rates. The first is the stated or coupon rate. This is used to compute the amount of cash paid to bondholders. And then the market rate is used to price the bond issue. If the stated rate is equal to the market rate, then the issue price will be equal to the face value and it'll be a par bond. If the stated rate is less than the market rate, then the issue price is less than face value and it's a discount bond. And if the stated rate is greater than the market rate, the issue price is greater than face value and it is a premium bond. And then the effective interest method is where you take interest revenue equal to the market rate used to price the bond issue times the carry value or the book value. And then carry value is equal to par plus or minus the premium or discount. And then we'll get into this a little bit more with the next part. So first, held to maturity securities. Again, you ignore changes in fair value and there is no fair value adjustment entry in your journal entries. So first we're going to make a bond amortization schedule. You're going to have the date, you're going to have the amount of cash paid, which is the par times the stated rate times time, and then interest revenue is the carry value times the market rate times time, and then amortization is the absolute value of the difference between the cash paid and the interest revenue. The premium or discount balance is the previous balance in the bond minus your amortization. And then your bond carry value is again the par plus or minus the premium discount. For your journal entries, first you're going to record the purchase of the bond with a debit to the debt investment and a credit to cash. The credit to cash is at the issue price, and then the debit to debt investment is just equal to that. Then you have an adjusting journal entry to accrue interest revenue. You're going to debit cash or interest receivable, depending on if you're not getting cash right away. You're also going to debit your debt investment again, and credit interest revenue. The debit to cash is again the time times the stated rate times the par or face value. Again, that's the same amount up here. And then interest revenue is time times the market rate times the carry value. Same thing as in the table. And then debt investment, you either plug to balance the entry or it's the amortization from the table. That's for a discount bond. If you had a par bond, you would have no debit to debt investment, and for a premium bond, you would actually credit the debt investment. Then for the sale of the bonds, you're going to debit cash, which is the given selling price. You're going to credit gain on sale of investment, and you're going to credit the debt investment. The credit to the debt investment is the amortized cost amount, so it should be your carry value. And then the plug to value balance for the gain on sale of investment. Next, for trading securities, this is where we're going to get into fair value adjustments. And for trading securities, those go into net income on the income statement. Fair value adjustment is an asset, and so it has a regular debit balance. The amortization schedule is the exact same as it was for held to maturity securities. The journal entry for the bond purchase is the same. The journal entry to record interest is the same. And those were the only two that we had here other than the sale. So then to adjust for fair value, we have to do that first. So you can make a little T account for the fair value adjustment where you have the beginning balance and the ending balance, which is the fair value minus amortized cost. And if it's positive, it's a debit. If it's negative, it's a credit. And then this star indicates what we're going to put in the journal entry for the fair value adjustment. So you either are going to debit fair value adjustment and credit the unrealized gain to net income, or if it's a loss, you debit the unrealized loss to net income and you credit the fair value adjustment. And then sale of bonds is the same journal entry as the held to maturity securities. And then your final fair value adjustment, you want to put your end balance to 0 because the security has been sold, so it has no fair value to the company. And then lastly, we have available for sale securities. These again have your fair value adjustment, but it's in other comprehensive income, which is on the balance sheet within the shareholders' equity portion. The amortization schedule is the same, bond purchase is the same, to record interest is the same, to adjust fair value is basically the same, except your unrealized gain or unrealized loss is in other comprehensive income as opposed to net income. Sale of bonds is the same, and then same thing for your final fair value adjustment, has to be equal to 0. Next up is equity securities. So as opposed to buying a bond, if you're buying equity within another company, that's another type of security or type of investment. The two types that we're going to explore here, first is if you lack significant influence, which means you own less than 20% of that company, you recognize this at fair value, and it's treated similarly to a trading security where the financial statement impact is a fair value adjustment to net income. And then the other type that we're going to look at in this class is significant influence, which is you own 20 to 50% of the company. And then this is recognized at the equity method. There's no fair value, and then you record at cost, and then you adjust for the share of net income and dividends. And then not tested is controlling influence over 50%. So for insignificant influence, you record the dividends declared as revenue within net income. So your journal entries, to purchase the equity investment, you debit equity investment at the purchase price times the number of shares, and you credit cash just to plug the entry in. When you declare and pay dividends, you debit cash for the total dividend times the percent ownership in the company, and then you credit dividend revenue, again, that same amount. To adjust fair value is, again, this same table, and again, the same as trading securities. We're going to debit the fair value adjustment, credit the unrealized gain to net income, or again, the opposite for a loss, but it's important to remember that it's in net income. And then the sale of the investment, you're going to debit cash at the given selling price, credit the gain on the sale of investment, and credit the equity investment at cost. And then the same thing for the final fair value adjustment to 0. And then for significant influence, we're using the equity method. So you adjust the investment and the net income for the investor's share of net income or loss. And then you lower the investment for the share of dividends declared, and you ignore changes in fair value. For journal entries, the purchase is the exact same as if you have insignificant influence. And then to record interest in net income, you debit your equity investment by the total net income times your percentage ownership, and you credit investment income by that same amount. Because again, your equity investment is going to increase because you have such a significant ownership in the net income. And then for declared dividends, you're going to debit cash, which is the total dividend times the percent ownership, and then credit your equity investment by that same amount. So that was it for investments for the securities, both debt securities and equity securities. So next is topic 13, which is taxes. So the big thing looking at here is the types of differences within these accounts. I'm actually gonna flip this really quickly. So there's different types of differences. There's permanent differences and there's temporary differences. So this little chart here helped me understand when you report different gap and tax things in different places. So if an item is reported on gap, but it's not reported in tax, that's a permanent difference. And then vice versa, if it's not in gap but it is in tax, that's also a permanent difference. And then this is where the effective tax rate will be different from the statutory tax rate, and we'll talk about that in a second. If we have an item that is reported in gap and is reported in tax, and is the same amount in the same period, there's no difference. So that doesn't make any difference. But if we have an item that is reported in gap and is reported in tax, but it's a different amount or it's in a different period, that's when we have a temporary difference, which will either lead to a deferred tax liability, where we have future taxable amounts, or a deferred tax asset, where we have future tax benefits and deductions. So looking at the effective tax rate first, if we have a permanent difference, the effective tax rate is equal to the income tax expense divided by the pre-tax gap income. So we're going to look at this calculation a bit, which is taking taxable income, which is the tax revenue, minus your tax expenses or deductions, which equals your tax income, times your tax rate gives you your tax payable. So this will give us our initial entry. The entry always starts with the credit to income tax payable, which is the tax payable amount. And then you're going to debit your DTA or credit your DTL, which is the amount of difference between the gap income and tax income times the tax rate. And then you're going to debit income tax expense as a plug to balance. So for an example where we have a permanent difference again, and we're looking at the effective tax rate, there's not going to be debit to DTA or credit to DTL because there's no DTA or DTL, it's only in temporary differences. So for a permanent difference, we need to reconcile the statutory and effective tax rate. So if we look at the gap income, we can get our tax expense. So similarly to above, we take the gap revenue and the gap expenses, which gives us pre-tax gap income, times the tax rate gives us our tax expense, which is notably different than our tax payable. So then this tax expense, we're going to do, to disclose for that, we take the tax rate, the given tax rate is the statutory rate, find the tax exempt income, which we will find given the effective rate, because again, the effective tax rate is our income tax expense divided by pre-tax gap income. So it'll be different than this tax rate. No, because it should be the income tax payable over the pre-tax gap income. Sorry about that. It should be that calculation, because as we see here, if you take the tax payable over the pre-tax gap income, that'll give us the effective rate. And then the difference between these two rates gives us the tax exempt income, like rate of sorts. So now let's look at the temporary differences that are cause deferred tax liabilities and deferred tax assets. So if you have a deferred tax liability, you have higher fixed assets, you have a liability which is a risk, and you have a higher future taxes. And then your DTL is equal to the amount of difference between the gap income and tax income times your tax rate. So again, we have the same taxable income calculation. We can have that for multiple years. And then our DTL schedule, where we have gap minus tax, which gives us the difference, times the rate, which again gives us our DTL. Our journal entry in the first year, we're going to do this exact same entry that I showed before. That wasn't really applicable to when you have a permanent difference, but it is applicable here. We're going to make a credit to income tax payable from our tax payable in our taxable income calculation, debit to the DTA or credit to the DTL, in this example the DTL from there, and then debit to the income tax expense, which is the plug to balance. And then you're going to reverse this over time. That reverses over time. So you're actually going to either debit the DTL or credit the DTA. So in terms of a DTL, we're going to make a debit to that because initially a DTL has a credit balance because it's a liability, but we're going to debit it to cancel out that DTL. For financial statement notes, your income tax expense, the current income tax expense is your income tax payable. Your deferred tax expense is your DTL or DTA. It's going to be a positive amount if it's a DTL and a negative amount if it's a DTA. And then your total income tax expense is the expense amount, or you just plug it to balance. And then DTA, you have lower future taxes, and the DTA is the amount of difference times the tax rate. Basically the same thing that we looked at for DTL, just it's an asset instead of a liability. So valuation allowances you can have if you have a DTA, where it's more likely than not that you're going to have an unrealized receipt. The allowance to reduce DTA is what we have here, which is a contra asset to your deferred tax asset. So its normal balance is a credit. So your journal entry to establish the valuation allowance is a debit to income tax expense and a credit to the allowance to reduce DTA. And then this will just be for whatever given amount of allowance that you have. And then the last kind of exception for this chapter is looking at net operating losses. For your year one tax entry, you're going to make there's no income tax payable because there's no taxable amounts. Because you have a net operating loss, so you can't have a tax payable, but you are going to make a debit to your DTA, which is going to be your carry forward times your tax rate, and then a credit to income tax expense or benefit for the equal to or plug. Then our year two tax entry gets a little bit more complicated. So you take your tax income times the 80% maximum offset that you can have of the carry forward. So that'll give you your max carry forward amount. So then you take your taxable income before the carry forward, subtract this applied max carry forward that we have, then you find the taxable income after the carry forward, apply the tax rate, and get your total final tax payable. And so here we're going to credit income tax payable for this amount, credit the DTA for the reversal, which is going to be the carry forward that we calculated, times the tax rate, and then debit income tax expense through the plug. So that was everything for taxes, remembering the different types of deferred tax assets, deferred tax liabilities, etc. Topic 14 is leases. So there's two different types of lease classifications. First is a finance lease, where you meet one or more of these criteria that I'll cover in a second. Then an operating lease meets none of those criteria. So the first test is an ownership test. The ownership test states that ownership will transfer to the lessee at the end of the lease term. A purchase option test means that there's a bargain purchase option within the lease terms. Lease term test means that the term of the lease is greater than 75% of the remaining economic life of the item that is being leased. The present value test means that the present value of the lease payments is greater than 90% fair value. Here, wait, this should be in parentheses. The present value of the lease payments should be greater than 90% of the fair value of the asset. And then to find the present value of those lease payments, we are going to do the payment amount times the present value of an annuity due factor, using the rate and using the number of terms within the lease. And then alternative use test is the last one. That means that there is no alternative use to the item being leased and it is specialized. So these 5 tests altogether are what tell us if we have a finance lease or an operating lease. It's important to remember what they are. I'm gonna try to do that. The only acronym I thought of, just because we did it in this order, was like OPLPA, but I don't think that's super helpful. But yeah, remembering those tests is important. So then first, looking at finance leases, we're going to record a lease liability and record a right of use asset, which is equal to the present value of the lease payments. And it's important to use the discount rate of the implicit rate that is given. And then the right of use asset is equal to the lease liability. We're going to make a lease liability schedule when we have a finance lease and when we have an operating lease, but more about that in a second. So the lease liability schedule will first have the date, then it'll have your lease payment, which is given, then it'll have the interest on the liability, which is the beginning lease liability balance times the rate. The lease liability change is the lease payment minus the interest on the liability. And then the lease liability, it's essentially the carry value, is the beginning lease liability balance minus this lease liability change. So then our journal entries. For year one, we have 4 entries for financial leases. First is to record the asset and the liability, This is in January at the start of the year. We debit the right of use asset for that present value of payments amount, and we credit the lease liability for that same amount. Then we record payment, which is going to be again in January, and it is a debit to the lease liability and a credit to cash for the lease payment amount, again within both accounts. Then we're going to record interest in December at the end of the year through a debit to interest expense, which is at the interest amount, and a credit to lease liability for that same amount. And then lastly, for year one, we're going to record the amortization of the ROU asset. We amortize ROU assets straight line over the lease term. Again, at the end of the year, we're going to make a debit to amortization expense and a credit to the ROU asset, and the amount is the ROU carry value divided by the lease term. Then for year two, we still record the payment, we still record the interest, and we still record amortization for the ROU asset through these same three entries. And then for the last year, you don't have any interest. You just record the payment and the amortization for the ROU asset. Next, for operating leases, you're going to again record the lease liability and the ROU asset for that same value, the present value of the lease payments, and then you're going to record the lease expense for each period. There's no interest expense and no amortization expense. The lease liability schedule, like I said, is the exact same as it was for finance leases, but we also have an ROU asset schedule when we have operating leases. So we have the date, the lease expense, which is equal to your payment, the interest on liability, which is the same as it was in the lease liability schedule, the ROU asset change is equal to the lease expense minus the interest on the liability, and then the ROU asset is the beginning balance minus the change. So this change. So your journal entries for year one, again, remember there's no interest and no amortization. The journal entry first to record the asset and the liability is the exact same as it was before. You're going to debit your ROU asset, credit lease liability for that present value of payments amount. And then B, to record the payment is exactly the same, debit lease liability, credit cash for the lease payment amount. And then this is the different entry to record lease expense. At the end of the year in December, you're going to debit your lease expense, credit your lease liability, and credit your ROU asset. So the debit to lease expense is equal to your payment amount, the credit to lease liability is equal to your interest amount, and the credit to the ROU asset is a plug, or you can also find it in the ROU schedule as the ROU asset change. So again, all these numbers you can find from this ROU asset schedule, but here's just the very basic way to calculate them. Journal entries for year two, you're going to once again record your payment, entry B, and record the lease expense, entry C. There's no need to do entry A because, again, we're not getting a new asset and a new lease liability. And then in the last year, it's basically the same. You're still recording the payment, you're still recording the lease expense, but there's going to be no credit to the lease liability because, again, that interest amount in the last year is going to be equal to 0. That was it for leases. So again, remembering the different types of leases, how we qualify them, and then obviously accounting for them slightly differently. The last topic that we look at is equity. So first, just to look at some T accounts, the normal balance of stockholders' equity is a credit. So when we look at paid-in capital, particularly capital stock, common stock, preferred stock, additional paid-in capital, it's all going to have a normal credit balance. Retained earnings has a normal credit balance. And then treasury stock is the one abnormal one. It is actually a contra stockholders' equity account, so it has a normal debit balance. So breaking down paid-in capital a little bit more, also known as contributed capital, we have the 3 sections: common stock, preferred stock, and additional paid-in capital. The number of shares of stock, we have this little tree map that we made that helps me understand a little bit better. So the authorized is the total number of shares that you can have, and then there's stocks that are either issued or they are unissued. Of the issued shares, you can have either outstanding shares or treasury shares that the company has reacquired. So accounting for stock issuances, particularly of common stock, you're going to credit common stock at par, the stated value, credit the excess over par to paid-in capital excess of par, and if it's a no par stock, you're going to credit common stock for the full proceeds. So like we see here, we're going to debit cash, credit common stock, and credit the additional paid-in capital. The credit to common stock, once again, is the par times the number of shares. The debit to cash is the cash times the number of shares, which is the market price. And then the additional paid in capital amount is going to be a plug to balance or a zero if there is no par value, like we said about no par stocks right there. For the issuance of preferred stock, it's slightly different. We're going to have a debit to cash, a credit to preferred stock, and a credit to additional paid in capital for preferred stock. But otherwise, these amounts are all calculated the same. And then what's important with preferred stock is when we convert preferred stock to common stock. So we're going to debit our preferred stock and debit our additional paid in capital on that preferred stock to kind of get rid of it. So these are going to be the same amounts from this first entry because we're getting rid of the preferred stock. And then it's going to be a credit to common stock and a credit to the additional paid in capital for common stock. The credit to common stock is the common stock par times the number of preferred stock shares that we're converting, and then the conversion factor. And then you're going to plug to balance with the additional paid in capital for common stock. And then talking a little bit about treasury stock and earnings per share. Earnings per share is net income divided by shares outstanding. So you have less shares outstanding if you reacquire shares to become treasury stock. So the lower shares out can sometimes raise your earnings per share, which is sometimes why companies have treasury stock. Treasury stock is accounted for using the cost method, so it's always recorded at cost. For the journal entries, first to record the reacquisition, we're going to debit treasury stock and credit cash. The credit to cash is the share price or the cost times the number of shares, and then the same amount for the debit. The reissuance above cost is going to be a debit to cash, a credit to treasury stock, and a credit to additional paid in capital. So the debit to cash is the market price times the number of shares. The credit to treasury stock is the cost times the number of shares, and the credit to additional paid in capital is a plug to balance. But a reissuance below cost is a little bit different. You're going to make a debit to cash, a debit to additional paid in capital, a debit to retained earnings, and then a credit to treasury stock. So your debit to cash is the same, the market price times the number of shares. The debit to additional paid in capital is the maximum amount. So whatever we had in this previous entry is our maximum amount because we cannot have a debit balance in additional paid in capital. So we put that in here. And then your credit to treasury stock is going to be the same. It's going to be the cost times the number of shares. And then retained earnings takes whatever is extra. It takes that plug to balance to cancel everything out. And then looking at dividends. Dividends have multiple dates associated with them: the date they are declared, the ex-dividend date, the record date, and the payment date. But the only two of these dates that require journal entries are the declaration date and the payment date. So those are the two journal entries I have here. First, on the declaration date, we're going to debit retained earnings and credit dividend payable. That credit is for the amount times the number of shares outstanding, and then that's the same for the debit. And then for the payment, we're going to debit dividend payable and credit cash, both for the same amount that we calculated in the first entry, the amount times the number of shares outstanding. Now, looking a little bit more about preferred stock and how that plays into dividends. Preferred stock leads to dividends in arrears, which are disclosed on financial statements. So our current dividends for preferred stock is equal to the par of preferred stock times the number of shares of preferred stock times the rate. Preferred dividends in arrears is the number of unpaid periods times this dividend for preferred stockholders amount. The total preferred dividend is going to be the arrears amount plus the current amount. And then common stockholders are going to get the remainder of whatever dividend is declared. So to record that declaration, we're going to have a debit to retained earnings for that total dividend amount, a credit to dividend payable for preferred stockholders of the preferred dividend amount. So this was the first amount we calculated. And then a credit to dividend payable for common stock for the difference, the total dividend minus the preferred dividend. And then the last thing we talked about in terms of equity was stock splits. When you have a stock split, you have a higher number of shares, but a lower par value. And common stock is like the same, the value, because you have that increased number of shares and then decrease in par value. But that was it. I'm gonna quickly go through some of these journal entries one last time because I feel like that's the biggest thing I'm worried about on this exam, believe it or not. So when you're purchasing a bond, it's always a debit to debt investment because you have that new asset, the debt investment, and a credit to cash. It's always at issue price because that's obviously the amount that you're paying for that debt investment. For interest revenue, you debit cash, debit your debt investment, and credit interest revenue. Interest revenue is obviously the revenue, which makes sense why you would credit it. Debt investment is going up if it's a discount bond, going down if it's a premium bond, hence the credit to debt investment here. But the debit to cash is going to be times the stated rate times the par or face value, because interest receivable or cash is always based on the stated rate, but your interest revenue is the time times the market rate times the carried value. And then debt investment is the plug or amortization from your bond amortization schedule, which, to review again, your cash paid is the par times the stated rate times time. Interest revenue is carry value times market rate times time. Amortization is the difference. Premium or discount balance is the bond minus your amortization value, and then the carry value is the par plus or minus the premium discount amount. And then to sell your bonds, you debit cash, credit the gain on the sale and investment, and credit your debt investment. The debit to cash is the selling price that's given. Your credit to debt investment is that amortized cost, and then you plug to find the gain on sale. And then when you adjust for fair value for trading securities, you debit fair value and credit an unrealized gain to net income, or you debit an unrealized loss to net income and you credit the fair value adjustment, which makes sense because an unrealized loss has a normal debit balance, an unrealized gain has a normal credit balance. So depending on this will affect which way your entry is set up. And then available for sale security, same thing, except unrealized gains go to other comprehensive income and unrealized losses go to other comprehensive income. For equity securities, it's the same, except we're debiting equity investment instead of cash, and the amount is a little bit different. It's the purchase price times the number of shares. For dividends, we debit cash because we're receiving cash when we get our dividend, which is the total dividend times the percent ownership, and then credit dividend revenue. This is specifically for insignificant influence when we do this dividend amount. And then again, the fair value adjustment is the same, net income because it's treated like a trading security. And then the sale of investment, debit cash, credit the gain, credit the equity investment at cost, but otherwise this is the same as the sale of a debt investment. And then for significant influence, again, looking at the equity method, where the purchase is the same, so we're going to debit our equity investment, credit cash, but interest as part of net income, we debit our equity investment and credit investment income. So that's the total net income times the percent ownership. And then for dividends, we're going to debit cash and credit our equity investment so that the amount goes down of our equity investment, and that's the total dividend times our percent ownership. For taxes, we're always going to have the credit to income tax payable for the tax payable amount, the debit to DTA or the credit to DTL for the amount of difference times the tax rate, and then a debit to income tax expense, unless we have a reversal, in which case we debit a liability, credit an asset. For valuation allowances, we have the allowance to reduce DTA, which is a credit, and then income tax expense as a debit. Net operating losses, there's no income tax payable in our entry, but we do have our DTA as a debit. Yes, we debit our DTA, and then which is our carry forward, times our tax rate, and then the credit to income tax expense or benefit which is a plug. And then for our tax entry, after we do all of these calculations, we find the credit to income tax expense with this given amount, the credit to the DTA to reverse it, which is the carry forward this year, times the tax rate. So as opposed to canceling out the entire DTA, we're only reversing that portion based on what percent of the carry forward we're canceling out. And then the debit to the income tax expense as a plug. And lastly, for leases, for finance leases, we do the recording of the asset and the liability through a debit to a right of use asset and a credit to the lease liability, which is the amount of the present value of the payments. To record the payment, we debit the lease liability and then we credit cash for the lease payment amount. To record interest, we debit interest expense and credit lease liability for the interest amount. And to record amortization, we do the ROU carry value over the lease term to get the straight line amortization, and then credit our ROU asset since obviously we're amortizing it. And then for year 2, there's no entry to record the asset and liability. For the last year, there's again no recording, and there's also no interest because there's no interest in that last year. Looking at our lease liability schedule a little bit more, our lease payment is given. The interest is the beginning lease liability balance times the rate. The lease liability change is the payment minus the interest. And the lease liability carry value is the beginning lease liability balance minus the change. For operating leases, the lease liability schedule is the same, but we also have an ROU asset schedule. The lease expense is equal to payment. Interest is the same. ROU asset change is expense minus interest, and then ROU asset is the beginning balance minus the change. Journal entries for year 1. Again, remember for an operating lease, there's no interest and no amortization. So we have this same entry to record the asset and the liability. The same entry to record payment, but the entry to record the lease expense is different, where we debit lease expense, credit lease liability, and credit the ROU asset. The lease expense is debited at the payment amount. The lease liability is credited at the interest amount, and the ROU asset is credited at the plug, or it's found in the ROU schedule as the ROU asset change. For year 2, we don't record this, but we record the payment and the lease expense. And then for the last year, same thing, we record these two, but there's no credit to lease liability since there's no interest. And now lastly, for equity, we have a stock issuance. We're going to debit cash, credit common stock, and credit additional paid-in capital. The debit to cash is cash times shares, and the credit to common stock is par times number of shares, and then you plug to get additional paid-in capital. Issuance of preferred stock is the same, par times the number of shares, cash times the number of shares is just preferred stock as opposed to common stock. Converting preferred stock to common stock, we're going to debit both of these accounts as opposed to crediting them to cancel them out, and then credit common stock for the common stock par value times the number of preferred stock shares being converted times the conversion factor, and then plug to get your additional paid-in capital on common stock. And then for treasury stock, when we're reacquiring, we debit treasury stock and credit cash. The credit to cash is the share price times the number of shares, and then we just plug that in to get our debit. A reissuance above cost, we debit cash for the market price times the number of shares, credit treasury stock for the cost times the number of shares, and credit additional paid-in capital at that plugged amount. Reissuance below cost, the debit to cash is the same, market price times number of shares. Our debit to additional paid-in capital is the max amount that we got in this past entry. Debit to retained earnings is a plug after we credit our treasury stock, which is the cost again times the number of shares. And then lastly, to declare a dividend, we debit retained earnings and credit dividend payable, the amount times the number of shares outstanding, and then to pay is the same amount, but we debit dividend payable and credit cash. Except for when we have dividends in arrears, where it's slightly different. We still have the debit to retained earnings. We still have the credit to dividend payable, It's just different amounts because the debit to retained earnings is our total dividend that we're given. Our credit to dividend payable for preferred stockholders is the preferred dividend amount. And then our credit to dividend payable for common stockholders is the difference between these two. And then again, dividends for preferred stock is par of preferred stock times the number of shared preferred stock times the rate, and the dividends in arrears is unpaid periods times the dividends preferred, and the total preferred dividend is the arrears plus the current. So that was everything. Wish me luck. Let's hope I remember these journal entries, but hope this was helpful.